All right, well, I wasn't going to make this video. I got all these messages. People said to me, will you talk about GameStop? And I thought everyone's spoken about GameStop. And more people said, tell me about GameStop, explain the GameStop story. And I just thought, nah, there's 100 videos on this. Not going to do it. But anyhow, I taught my first class at the university today, and the students all said to me, Patrick, tell me about GameStop. And I thought, I'll make a video on GameStop. So I guess to talk about GameStop, we have to start with Wall Street Bets. Who are Wall Street Bets? If you don't know, they're a group on Reddit. They've been all over the news for, I don't know, most of the pandemic for piling into stocks. That's what they do. And Wall Street Bets, they're basically a group of people. They're on Reddit. They talk about stocks or STONKS, and they pile into them. And they don't like to buy the stocks. They like to buy the options. They're my kind of person. They trade the options, you know. But anyhow, they like GameStop, and you might ask why do they like GameStop, or even what is GameStop? Of course, you've read the news, you probably know what GameStop is. But GameStop is a store in the United States. It's a retail store that sells mostly used video games. And the Redditors, they like video games. The Wall Street Bets boys, they play the video games. And so they like GameStop because they like video games, and in particular, they like secondhand video games. Now, a lot of people don't like GameStop, and the reason they don't like GameStop is it's not necessarily the best. It's not the best investment opportunity necessarily at the moment, and the reason for that is quite simply that it's a retail store, and retail has been hammered during the pandemic. They're selling secondhand video games, and the video games companies have started to move towards downloads. You know, you can download video games now. You don't necessarily get a DVD anymore, and so the second-hand video game market might be disappearing, but the Wall Street Bets boys don't care, and so they like GameStop, and they bought some calls. So what's happened? Why did they decide to buy the calls, and why is it a big deal? Well, they noticed that there's an awful lot of shorts out there. There's actually a greater than 100% short position in GameStop stock, and a lot of people have said to me, Patrick, how can there be greater than 100% short position? Well, it doesn't happen very much in markets, but it can happen. And the way it works is this. If you own stock, you can hold it at your broker, and you can lend out that stock, and your broker will pay you something to lend out that stock, and it's lent out to short sellers, okay? Now, when you lend the stock to the short sellers, the stock is transferred out of your account into the short seller's account, and they then sell that stock, but they have to, of course, at some point buy it back in order to return it to you. That's how shorting works, and I even put up a video probably a month ago explaining shorting, and it might be worth looking at that. So anyhow, big short position in this stock. But what happens? How's there more than 100% of a short position? Well, once you've lent it out, you no longer actually have the stock. You'll get the return of the stock because you're essentially in something a bit like a total return swap with the person who borrowed the stock from you, where you'll get paid the return of the stock, and you'll also get paid some sort of fee for agreeing to lend it out to that person. Now, that person might take the stock and they're going to sell it short, so someone else will then receive that stock. And that person is also able to lend out that stock, right? And so the stock can be lent out multiple times, meaning that there can be a greater than 100% short interest. So that's what's happened with GameStop. Now, a few of the big short sellers, they came out and they said, we don't like GameStop. They're not Wall Street Bets boys. They don't like the GameStop, and they sold it short. And not only did they sell it short, but they released reports explaining why it's a bad stock and why they sold it short. The Wall Street Bets boys, they did not like that. And so they bought options, and when you buy options, if you don't delta hedge them, if you just buy call options, what happens is that the person who sold you, usually the investment bank who sold you those options, is going to delta hedge them. They're going to hedge their risk exposure to those options, which involves buying the underlying stock. So whenever you buy options, someone sells you those options and they buy the underlying stock. And of course, an option position is usually a leveraged position, and so they end up buying more stock than they would have if you had just bought the stock yourself in the market. So all of this buying of options puts upward pressure on the stock. So where do we go from there? Well, a lot of people now, I read the financial press, or I watch a bit of CNBC, and I see a lot of what I would describe as pearl clutching of people saying, isn't this awful, that these crazy guys on Reddit are doing this thing, and it's squeezing these shorts positions. And I find it very difficult to care about this, because I just think this is the way the market is. People buy, people sell, people do what they're going to do. But a lot of people are saying, should the regulators get involved? Is this illegal? Well, there are a few things that are illegal. There's securities fraud and there's market manipulation that are illegal. Now, securities fraud would involve lying about the stock. You'd have to be telling lies. You'd have to claim that it's a great stock, maybe even publish false information about how good it is. The Wall Street bet boys aren't doing that. They're too busy eating chicken tenders. They don't care to publish false information. They just pile into the stock. Is it market manipulation? Well, market manipulation is sort of ill-defined a little bit in law. And the idea of market manipulation, or what market manipulation is supposed to be, is trading to create a false appearance of activity in a stock and essentially tricking the public into buying. So you're doing this sort of trading that's designed to make it look like there's a lot more interest in the stock than there actually is, and then possibly tricking the public into buying it. Now, the Wall Street bets boys, they're not really doing that. They're piling into the stock, or at least piling into call options on the stock. There's no false narrative being created. They're actually quite clear about what they're doing. They're piling into the stock and they're squeezing the shorts, and they're using leverage to make their positions have much more impact than they might normally do. It's not a pump and dump scheme, right? A pump and dump scheme, once again, you probably take a position early on, you sneak into your position, and then you create false rumors, and maybe you phone people up and tell them that they should buy this stock, or maybe you even have a chat room and you trade the stock yourself and you tell all your followers to trade it, and while they're buying, you're selling. The Wall Street bets boys, they're not really doing that either. They're piling into options, and those options will eventually expire, and they'll either be up or down on that trade. Now, that's US regulation. In the UK, regulation's a little bit different. They have this term market abuse, the FCA. You can get in trouble for market abuse. Could this be market abuse? I mean, it kind of could, but once again, it's because it's sort of an ill-defined term, and it's essentially anything that the FCA don't think that you should be doing. But I would argue that people can do what they want with their money, right? You can buy what you want. And the Wall Street bets boys, they're not really claiming to be doing anything other than gambling. They're not claiming to be making prudent investment decisions. They're not, putting away money for their retirement accounts. They're gambling on stocks. All the sports are closed down because of the pandemic. They have to have a bit of fun. This is how they're having fun. And you're allowed to do that. It's your money. You can do what you want. If you make money on it, happy days. If you lose money, it's your own money to lose. And, you go to a casino, you can do that. Why can't you do it here in GameStop? So while the price of GameStop may not necessarily reflect the future expected cash flows of the stock in the way that people like to talk about stocks, it does certainly reflect supply and demand. There's an awful lot of demand and not an awful lot of supply, and so the stock price has run way up. Now, in the world of derivatives, one of the things that's interesting from a derivatives perspective is that, with an awful lot of derivatives theory, pricing theory, the idea is that you price an option or a derivative off of the underlying stock, that the price of the underlying is supposed to drive the price of the derivative. But that's not really the case, and it hasn't been the case for a long time. I mean, an awful lot of options traders in general will take the implied volatility from a volatility swap and use that to price an option on an index, for example. So, one derivative's driving the price of another derivative, which is driving the price of the underlying. That's the world that we live in. Derivatives have just gotten big. So what's in this morning's news? Well, Melvin Capital and Citron, two big hedge funds who had positions in this, have covered their shorts apparently. They've announced that they've covered their shorts, and they probably have, because it would probably be illegal for them to announce that if they hadn't. Once again, I don't know. I'm not a lawyer. I'm not an expert on securities regulation. Another interesting idea in here that I think is that there's this concept of how markets work, the principle of ever-changing cycles. And it's essentially that when something works for a while, eventually it stops working. And for a long time, a lot of these firms, some of the big short sellers, have had this approach where they take a short position in a stock and then they publish sort of a research report explaining why it's a terrible stock. They publish that, and then that is supposed to sort of knock down the price as the rest of the market realizes that this short seller is correct. And that's a thing that some of these guys have done in the past. And now it has changed where actually having a huge short position makes you a target of, possibly the Wall Street Bets boys. And it's kind of smart of them, frankly, to target these huge short positions, because these people are sort of forced buyers, and the more it moves up, the more they lose. But it's kind of an inverse leverage position, and thus you can lose more than your initial capital when you short a stock. And I explained that in my earlier video about shorting. But anyhow, so historically the hedge funds, or some of these firms, have gotten away with this idea of publishing a bad report about a stock, and then that causes it to fall and they make money. And now all of a sudden it has changed that they possibly have to keep quiet about their short position because they don't want to get hammered by small traders who all pile in together. Now, back to the sort of regulation question, there are, of course, regulations against a coordinated attack on a given stock, but how coordinated is it? It's just a bunch of people on the internet saying, haha, this is funny, let's do this. No one has to do it. They're not that coordinated. They're not sort of a group that have entered an agreement to do a specific thing. They can do it or not if they don't want to, and it's a whole bunch of small positions. And if the SEC were to go after them, who do they go after? All of them? Anyone who bought an option on this stock? It's not obvious to me. An interesting story, I guess, relating to this. Matt Levine on Bloomberg wrote a good piece yesterday on the topic, and he told the story of Harbinger Capital and a rather similar sort of short trading story, where Phil Falcone, the fund manager at Harbinger, owned an awful lot of bonds in a company called Max, MAXX. And he realized that the broker was short them, and the broker was also encouraging other customers to short it. Now, I think he started out with around 75% of the float, so he owned about 75% of the bonds. He heard this. It annoyed him, so he just started buying up, and he bought all of the other bonds, and then he agreed to lend some of his bonds and to shorts, and so the shorts borrowed those bonds and sold them short, and then he took them all out of circulation. He called back the short. At one point, I guess the bank was on, or the broker was on the phone to him, and after he had stopped lending, and they said, what are we supposed to do in order to buy back these bonds? There's none of them out there. What's your suggestion? And he replied, just keep bidding. Sometimes you're just on the wrong side of a trade. Now, of course, he did get in trouble. The SEC did bring charges against him for that, so that's maybe not right when you control the entire float. But when a whole bunch of people are doing a thing that they want to do with their own money, it's hard to say if it's illegal or not, but it doesn't necessarily appear to be. So anyhow, that is my take on the GameStop and the Wall Street Bets boys. See you guys later. Bye.